If you think about it, investing in stock market sounds very simple on the surface. You just have to find good companies, buy them at right price and hold them for long term. But in reality, it's not that straightforward. Because finding good companies itself is difficult. You need to understand the business, track earnings, follow management commentary, keep an eye on valuation, and then even after doing all of that, you still need to deal with cycles, volatility and uncertainty. Now if you step back and think about it, the goal of investing is not to prove that you can pick the best stock. The goal is to participate in overall market growth in a reasonably consistent and stress-free way. And that's where you don't really need to pick individual stocks. At least not until you have enough experience and time to track the market. And that's where ETFs makes a lot of sense for retail investors. So let's try to build a complete portfolio using just 4 or 5 ETFs. The idea is not to make it perfect. The idea is to make it simple enough that you can actually stick with it over time. Because in stock market, the biggest strength is staying invested across cycles. Alright, let's look at the top ETFs to build a solid portfolio. If I have to pick just one ETF and build my entire portfolio around it, it would be Nifty 50 ETF. It represents the 50 largest companies in India that are market leaders across sectors like banking, IT, FMCG, energy and so on. These businesses have already proven themselves over a long period of time. So when you invest here, you are not really betting on one idea. You are participating in overall growth of India's economy. And if you look at history, despite all the volatility, corrections, cycles, the broader market has always moved up over the long term. Of course, there will be phases where Nifty underperform. There will be times when mid-cap or certain sector do better. But the point here is not to chase the best performing segment every year. The point is to have a strong, stable core that you don't have to constantly track or worry about. That's why, in my opinion, Nifty 50 should be the largest allocation in the portfolio with around 50-60% exposure. Now, within Nifty 50 ETF, the most obvious choice is Nifty Bees. To access all the ETF, you can visit Angel One. So if you simply search Nifty Bees, you can see the historical return. Then you have buy and sell price. Here, gap or spread between buy and sell price is very low. That suggests strong liquidity. Then you can see it has massive volume. Further, Nifty Bees is managed by Nippon India. It has a strong AUM of 57,000 crore. Then another important KPI is expense ratio, which is just 0.04%. Tracking error is again excellent at 0.02%. So when you scroll down further, you can see the fund holding by sectors where the bank has highest allocation, followed with IT software, refinery, auto and so on. And top holding include HDFC Bank, ICICI, Reliance, Airtel, L&T and so on. So think of Nifty Bees as your foundation. Not very exciting, not something you will keep checking every day, but probably the most important part of the entire portfolio. Then second ETF I would add to the portfolio is gold. Not for returns, but for stability. Because if you think about it, equity and gold behave very differently. There are phases when equities are doing extremely well, and at the same time, gold does almost nothing. And then there are phases when equities struggle, maybe due to global uncertainty, inflation, currency weakness, and that's when gold starts outperforming. We have already seen how gold prices have skyrocketed in last few years due to geopolitical uncertainty. In fact, gold becomes even more relevant for Indian investors because gold is a global asset. Hence, it acts as a hedge against INR depreciation. Over a long period of time, as the rupee weakens against the dollar, gold tends to hold its value better in INR terms. So indirectly, you are also protecting your purchasing power. Hence, it makes sense to have around 10-15% exposure in gold ETF. Now within gold ETF, one of the most popular and oldest ETF is Gold Bees. You can see the returns since launch. Buy and sell spread is again very low. Volume is very high. So liquidity is very good for Gold Bees. Again, this ETF is managed by Nippon India. Then AUM is very strong. Although expense ratio is on the higher side at 0.8% and tracking error is also slightly high. Here please note that while Gold Bees is the oldest and one of the most popular ETF, there are other ETFs also available in the gold category. For instance, you have Gold I ETF by ICICI Prudential that also has strong volume, high AUM and expense ratio and tracking error is better than Gold Bees. Then third ETF I would like to add to the portfolio is global ETF, something like a Nasdaq 100 ETF. Again, the idea here is risk management with global diversification. If you think about it, most Indian investors are almost entirely exposed to one economy. Their stocks are Indian, their mutual funds are Indian, their income is linked to India. So effectively, their entire financial life depends on how one country performs. Now that works well when India is doing well. But markets don't move in a straight line. There will be phases where India underperforms, growth slows down, or valuations become expensive. And at the same time, other markets might be doing much better. That's where something like a Nasdaq 100 ETF becomes useful. It gives you exposure to some of the largest global companies that are benefiting from themes like AI, cloud, and digital platform. So when you invest here, you're not just diversifying geographically, you're also adding a completely different growth engine to your portfolio. And if you look at global markets over the last decade, a significant portion of wealth creation has actually come from these kind of companies. Of course, there will be a period when US market underperform or tech corrects sharply. But again, the idea is not to time these cycles perfectly. The idea is to avoid being dependent on a single market. That's why I would like to allocate around 10-15% here. Not too large, but meaningful enough to make a difference over time. Another benefit of investment in US ETF is you are indirectly investing in dollar asset. So if INR depreciate over time, which it generally has, then also it adds to your return. Here you can consider Motilal Oswal Nasdaq 100 ETF. Its liquidity is decent in terms of volume turnover. AM is also decent. Expense ratio is slightly high at 0.59%, but tracking error is well under control. The fourth ETF I would like to add is a factor-based ETF, something like a Nifty 500 Momentum 50 ETF. Now this is slightly different from what we have discussed so far. Till now, we were either owning the broad market or adding diversification. But here you are making a small conscious tilt towards a certain strategy. In this case, momentum. If you simplify it, momentum investing is based on a very simple idea. Stocks that are doing well tend to continue doing well, or at least for some period of time. And instead of trying to identify those stocks yourself, this ETF does it for you using a rule-based approach. It selects companies that are showing strong price momentum and periodically rebalances the portfolio. Now the important thing to understand is this is not a magic strategy. Momentum works very well in trending markets, but it can underperform during sideways or volatile phases. So there will be periods where it does significantly better than the index, and there will be phases where it lags. That's why this is not your core allocation. It's more of a tactical layer with around 10-15% exposure. Something that can potentially enhance return over time, but also comes with higher volatility. So if you search Nifty 500 Momentum 50, you will find Motilal Oswal ETF that was launched on September 24. Although the volume of this ETF is not very high like Nifty Bs or Gold Bs, it's good enough to provide enough liquidity. Its expense ratio is 0.41. If you scroll down further to check the top holding, it includes Shriram Finance, Eicher Motor, Bajaj Finance, Mahindra & Mahindra, Hindalco, Maruti, Bharti Airtel and so on. Now before I move on to the fifth ETF, one of the most common query people have is, what is the difference between an ETF and mutual fund? Because you can find mutual fund for all these ETFs that we have discussed. So there's a fantastic feature on this Angel One app where you can go to help section and click on Ask Angel, which is a chat support powered by AI. Here you can type the question. So let's type, what is the difference between an ETF and mutual fund? And you can get the detailed explanation. Likewise, you can ask any question. Now let's look at the final ETF. The fifth ETF is more of an optional layer, but this is where things get a bit interesting. This is where you take exposure to specific growth themes. If you think about it, certain sectors go through strong multi-year cycle. For example, defense is benefiting from increasing government spending and localization. Similarly, capital market business tend to do well with rising financialization. More demat accounts, higher participation, increasing savings moving into equities. So through a thematic ETF, you are essentially trying to participate in these broader trends without picking individual stocks. Now it's true that these themes can be cyclical in the short term. There will be phases where they outperform sharply and phases where they correct or consolidate. But at the same time, many of these themes are backed by long-term structural tailwind. So over a longer period, the opportunity can still be quite meaningful. That's why the allocation should be balanced, around 10-15%. Enough to benefit if the theme plays out well, but not so large that your portfolio becomes only dependent on one particular sector. For example, within defense, you can explore Motilal Oswal Nifty India Defense ETF. It was launched on August 24. Liquidity is decent. Expense ratio is 0.41% and top holding include Bharat Electronics, Bharat Forge, HAL, then Solar Industries, Mexican Dock and so on. For capital market, you can explore Motilal Oswal Nifty Capital Market ETF. Its expense ratio is 0.53% and top holding include BSC, MCX, HDFC AMC, 361, CDSL and so on. So far in this video, we have discussed top 5 ETFs that you can consider to build a solid portfolio. But knowing which ETF to buy is actually only half the job. Because two ETFs can track the same exact index and still give you slightly different returns over time. And that difference does not come from the index. It comes from what is happening under the hood. And honestly, this is what separates an informed investor from someone who just picked the first ETF they see on Google. The first thing to look at is the expense ratio. This is the annual fee the ETF charges. Now in most cases, the difference may look small like 0.1%, 0.2%, but over a long period, it compounds. So lower cost is always better, but only if everything else is in place. For example, within Nifty 50, you have multiple ETFs like SBI Nifty 50 ETF. It has an expense ratio of 0.04%. Whereas ICICI Prudential Nifty 50 ETF expense ratio is 0.02%. Then second factor is tracking error. This basically tells you how closely the ETF is actually following the index, because the whole purpose of an ETF is to replicate the index, not deviate from it. So if tracking error is high, then even if you pick the right index, your returns may not match it. To learn more about it, you can simply ask Angel what is tracking error and you can get all the details. Then comes your AUM. Asset under management. A higher AUM means more investors are trading this ETF, which means better liquidity. Better liquidity means tighter bid-ask spread. It means you buy closer to the actual price and sell closer to the actual price. For small or niche ETF with very low AUM, you might end up paying a hidden cost every time you trade just because there aren't enough buyers and sellers in the market. So the rule of thumb is, for equity ETF, prefer those with AUM above 500 crore. For gold and silver ETF, above 100 crore is generally safe. Now, one of the most practical and often ignored factor is liquidity. Liquidity determines how easily you can buy and sell the ETF without impacting the price. And this is where bid-ask spread becomes important. Whenever you open the order book, you will see a buy price and a sell price. The difference between the two is the spread. The smaller the spread, the better it is for you, because that's essentially your hidden cost of entering and exiting. For instance, if you look at Nifty B's buy and sell price, the difference is negligible. However, when you look at thematic ETF, let's say capital market, the difference between buy and sell price is on higher side. This is generally critical when you are buying meaningful quantity. Then another factor to watch is whether the ETF is trading at a premium or discount to its NAV. Ideally, the price of the ETF should be very close to its NAV. If it's consistently trading at a premium, you are effectively overpaying. If it is a discount, it might look attractive but can also indicate liquidity issues. So small differences are fine, but large and consistent deviation are something to be cautious about. And finally, one small but important detail is dividend versus growth option. Some ETFs distribute dividends while others reinvest them. Over long periods, growth options tend to be more efficient because of compounding. But again, this depends on your preference and how you want your cash flow. So in this video, we discussed 5 ETFs that can help you build a solid portfolio. First is Nifty 50 ETF, which is your core foundation that participate in India's long-term growth, and you can allocate somewhere around 50-60%. Second is Gold ETF. It provides stability and hedge during uncertain times, and you can consider 10-15% exposure. Third is Nasdaq 100 ETF. It provides global diversification and exposure to innovation. Again, 10-15% allocation is good enough. Fourth is Nifty 500 Momentum 50 ETF. It's a tactical layer to enhance return, and allocation can be 10-15%. And finally, you have thematic ETF like defense or capital market, which is a play on long-term structural opportunity. Allocation-wise, 10-15% is good enough. So yeah, that's it from my side in this video. If you have any question, let me know in the comment. And if you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.